We begin today with a geopolitical flashpoint that is sending shockwaves through global energy markets this Friday morning. Iran's chief negotiator has publicly accused the Trump administration of engaging in what he called theater diplomacy, flatly rejecting U.S. diplomatic overtures and signaling that meaningful negotiations are effectively dead in the water. The consequence is immediate and measurable. Traffic through the Strait of Hormuz, the world's most critical oil chokepoint, is approaching a standstill, threatening a supply shock that markets had not fully priced in just days ago. This is a 10 out of 10 macro impact event unfolding in real time. Here is the hard reality the data is showing us this morning. The Strait of Hormuz is the passage through which approximately 21% of all global seaborne oil transits every single day. When that corridor functionally seizes, it does not just affect regional players. It reprices energy globally within hours. Iran's chief negotiator's public rejection of U.S. overtures as theater diplomacy removes the diplomatic off-ramp that energy traders had been betting on as a stabilizing mechanism. Brent crude this morning is sitting at 81.69, already volatile on session moves, while WNT offshore holds at 76.59, and the real risk is that both legs sprint significantly higher if closure is confirmed. The macro context here is critical, and Wall Street's prior positioning makes this story even more dangerous. Consensus through early 2026 had priced in elevated geopolitical risk premiums, but the base assumption was a functional Hormuz with tensions that remained diplomatically containable. Nobody in the sell-side community modeled a near standstill scenario as their base case, which means exposure across energy, credit, and equity desks is almost certainly underhedged for this outcome. When the critical assumption underneath a risk premium turns out to be wrong, not marginally wrong, but structurally wrong, the repricing is rarely orderly. Today's gold surged to 4,383.50, up 3.34%, and silver's rally represent the clearest red on institutional fear right now. Let us be specific about who sits on which side of this trade. On the beneficiary side, energy names inside the energy sector face an asymmetric upside if WNT offshore breaks convincingly above 80 toward the 85 level, which analysts are watching as the threshold that signals a genuine supply premium, not just fear noise. Defense contractors RTX and peers like Lockheed Martin and Northrop Grumman are catching bid on elevated geopolitical capex expectations. Regional conflict of this magnitude historically accelerates procurement cycles. On the losing side, the broad indices are already under pressure. The S&P 500 is at 768.56, the Nasdaq 100 at 714.65, and the Dow at 538.19, reflecting the growth derating that an energy spike typically forces on forward earnings estimates. There are three specific levels traders need to have on their screens going into the weekend. First, WNT offshore crude at 85 is the line in the sand. A sustained break above that level confirms the market is pricing a genuine supply disruption, not a temporary fear spike, and historically that triggers forced energy sector rotation. Second, the 10-year Treasury yield currently sits at 4.67%. A move above 4.80 would signal that the risk-off flight to safety bid is overpowering inflation concerns and that institutions are moving to duration. Third, the VIX at 15.18 looks deceptively calm. A spike above 18 would indicate the derivatives market is repricing conflict tail risk in earnest and could cascade into forced equity deleveraging. The single most important discipline right now is separating geopolitical noise from a genuine structural supply disruption, and the Hormuz traffic data over the coming days will make that distinction for you. A sustained Brent to WNT offshore spread exceeding 5 alongside documented shipping delays would confirm the supply fear premium is real. That scenario points to energy sector outperformance and meaningful S&P downside pressure. Until the traffic data is unambiguous, traders should respect the key levels. Watch gold at 4,383.50 for extension toward 4,500, and avoid fighting the defense names. That is the one story defining global macro risk this Friday. Stay with us. If this breakdown gave you an edge, hit subscribe and turn on the notification bell so you never miss a daily market recap. We cover the stories that move your portfolio every trading day, first thing in the morning.